Hi everyone, I'm Jen Chang. I'm a tax director at PwC based in Tyson's Corner. I'm in our financial services practice, and I actually came from our private company services practice in 2009, where I spent quite a bit of time working on individual taxes and some other planning for individuals. And so I've been a Georgetown grad from quite a few years ago, but so I'm thrilled to come back to campus at any opportunity. And been doing this for a few years now, and I've brought with me two coworkers of mine that are in the personal financial services practice, which focuses a lot on high net worth individuals. So I'll let Paul and Levi introduce themselves.
So I'm Levi. I'm a second year associate at PwC, as Jen said. Let's see, a few other things. If you do a 1040 EZ, let's see, interest income has to be under $1,500. It's one of the requirements. Basically, if you can do a 1040, I would recommend that because that's what you'll be doing, so better get used to that. But there's some more options.
From top to bottom, it goes easiest and most restrictive to most difficult, offering like the more complicated aspects to the least restrictive. So it's kind of like a sliding scale. The easier returns they're much easier to do, but they're more restrictive as to what you can do on the form. Whereas the more broad 1040 that can be the quote-unquote harder form is the least restrictive. Does that make sense? Did I say that right?
Yeah.
Okay.
Do you have a question?
Yeah. What is, could you explain what education credit and IRA?
Yeah, you're good.
Yeah, that one.
Yeah.
And then what is an itemized deduction?
Yeah. So we'll go and we have slides going through all those, but I'll just, an education credit, there are a few different credits that are offered that you should be familiar with because they're pretty good credits, and Paul's going to talk about those later, but yeah, they're good credits that you can take, so we'll talk about that later. The IRA, that's if you contribute to a retirement account, an individual retirement account is what it stands for. So if you contribute to one, it's tax deductible now, you're deferring that, so you don't have to pick that up in income. Have you heard of a Roth IRA or a Roth 401k? So the Roth just means it's the opposite. So Roth means you contribute with money that you've already paid tax on now, and then it'll grow in the account, and then when you withdraw it later when you're retired, you don't pay tax on it then. A regular IRA or a 401k is the same thing. You contribute to it now with money that you haven't been taxed on, and it will grow, and then when you pull it out, then you have to pay tax on it. So it's kind of like, do I want to pay tax now or pay tax later? It's kind of the thing. But if you contribute to an IRA, you're allowed to deduct it now. Yeah.
Do you recommend now or later?
I mean, a lot of this is like, there's also, you need to have self-employment income, and there's a lot of different things that come with IRAs. We call it an IRA, that's what we call it too. You don't really have to worry about it. I mean, broadly speaking, until you start being fully employed, like full-time employment is when you really need to start thinking about IRAs, 401ks. It's always great to put away for retirement. I'm not saying don't start doing that now, but you can accomplish similar aspects if you don't do all that just with a savings account. Just keep it simple. Yeah, keep it simple until you need to make it complicated, right?
But with the Roth IRA, then, I mean, essentially, if you can like pay your taxes now and then like let it grow,
It'll grow.
Sure,
right?
sure.
The growth is not taxed.
then you're going to be taxed at like a lot smaller rate now
Yeah.
than it would be later.
I personally have a Roth. I have a 401k and a Roth, but I like the Roth for that reason because it'll grow.
As your
But
taxable.
it's not taxable.
But it has like a maximum contribution amount, right, per year.
Per year.
It's like 55, I think.
Well, there's an income limit, and then there is a contribution limit.
Okay. Cool.
Yeah. Yeah. The Roth is, in general, for people that can, I'll call it, afford a Roth, right? Because some people need the deduction, right? Because they need the cash back as a refund. And there's no problem with that. That's why it's even available, right? That if you contribute to a traditional IRA, that you're afforded a deduction. But people can also have the option to contribute to a Roth IRA if they don't necessarily need that refund today. And so if that is something that you're able to do, right? That's certainly a wonderful option, right? Because just like we're discussing, that will grow tax-free. And that's, in terms of retirement planning, pretty much a home run.
Okay, let's move on. So this is what the 1040 looks like, the most complicated one. Who here has seen this or familiar with this at all? I'm happy. So I have this handout. I'll hand out now. It shows the basic tax equation. Just want to take one pass it. So we're just showing you this so you can see what it looks like, get familiar with it. But really, it's not as complicated as it looks. You just got to look at it in chunks. So when you get that handout, it kind of shows the more basic equation of how the numbers flow. So at the top, you fill out your name and information, your social security number. You'll pick a filing status, exemptions, which we'll talk about. But really, this section right here, lines 7 through 22, that's all your income. W-2s, interest, dividends, if you have a side business, any kind of income that you get, it's just gonna be in that section. Then this section is just some deductions. So you gotta offset some of that income. As you can see, like the student loan interest, that's right here, line 33. So that's where you take that deduction. If you move to a new state, you can deduct the moving expenses. So there's just a few deductions. So if you just look at it as chunks, income, deductions, and then at the bottom here, this is adjusted gross income after you subtract out these deductions. And that's an important number. We refer to that as AGI, or the line. So these deductions right here, we call above the line deductions because they're taken into account before AGI. And then if we go to the next page, page 2, that it starts with AGI at the top. So the bottom of page 1 is the same number as the top of page 2. So the line is really just the split between page 1 and page 2. And then there's additional deductions, which are itemized deductions like you're talking about. Those are below the line deductions. We'll talk about this more in depth, so I'm just kind of giving you a high level. But then you just, after you subtract those deductions, you then have exemptions and come to taxable income, multiply it by a tax rate, and then you can take credits. Who knows what the difference between a credit and a deduction is?
Good, we're gonna cover it.
We'll cover it. So I'll let you talk about that. Any questions about the form? Does everyone have that handout? Yeah, so you can kind of see on this handout what lines correlate, but pretty much it's just those main topics. So don't get too overwhelmed with the form.
So the reason why we wanted to bring this up in the beginning of the presentation is because as we go through different points, deductions, credits, income, that type of thing, you can start to orient that part of the discussion to where it falls on the actual form. Right, so that's why I wanted to go through this first, but we're going to continually refer back to this. So if it's a little bit hazy right now, that's totally fine. Right? We'll come back to this, and hopefully by the end, it'll be a little more clear.
Right. Okay.
This is me. All right. Anyone in here married? Okay. Anyone in here unmarried and have a child? Okay. Everyone in this room will file single. All right. Unless there's some other extenuating circumstances I have not foreseen, almost all of you will file single. And it's very, very intuitive. Single is single. Head of household we'll talk about just in a second. You have married filing jointly, which means like I'm married, so my wife and I, if we choose, will file on one single tax return. That's why if you look on the first page of the 1040, there's a spot for 2 taxpayers. You have taxpayer and then the spouse. It's just how it is. It should just be taxpayer, but hey, I'm not one to tell the IRS how to make their rules. And then you have married filing separately. So my wife and I took advantage of this. In our situation, we had lower income for student loan repayments. So if you are on plans for IDR, which is income-driven repayment, which some of you might be eventually, those payments that you have to make every month on your federally subsidized student loans are calculated based off of your taxable income. So they look at your tax return from the prior year. And a way to make sure those payments are as low as possible, because again, you're trying to live and eat and be a normal person and not pay all of your money to student loans, right? A way to kind of game the system is to file separately. Now, you don't get certain advantages of married filing jointly. That's obviously the best one. So tax rates are a little bit better, and you may, credits, and you may have to itemize if the spouse itemizes. But what it does is allows you to lower your payments, because the IRS is just going to see one separate income, not the joint income. So let's say my income was $60,000 and my spouse's income was $60,000. So if we file jointly, that's $120,000. The government is going to say, oh, you make a total of $120,000, we're going to base our payments off of that $120,000. But if I do married filing separately, they're going to say, hey, you just have $60,000 of income. We'll lower that payment down to make it a little bit more reasonable based on your income. So that's one of the main reasons that, people today really file separately. You also see sometimes in divorce or other kind of sticky situations like that. But the most common, I'd say, are probably single and married filing jointly. Head of household is commonly used after a death of the spouse or even after a divorce for whoever is taking care of the child. So there's 3 requirements. You need a child. You need a dependent, I should say, not necessarily.
Not a dog.
Yeah, not a dog. Pay more than half of the household expenses, so you're outlaying for you and your child to live, you're outlaying at least half of it. That can be kind of an odd calculation if you take into consider alimony, if it's a divorce, but put that aside. Be considered unmarried for the tax year. Again, this comes in divorce and death. You must have a qualifying child or dependent. This could also be a qualifying relative, if I recall. And head of household also, you can do it for qualifying relative. But again, I think I filed maybe 1 or 2 returns in my career so far with head of household, and it was always after a spouse died, unexpectedly. The most common are single and marrying filing jointly. Any questions? Again, unless you, oh, there it is.
How does a relative qualify?
If you pay, they can be, let's say Levi is my cousin, and he's living in my home and he's infirm, right? He had a terrible accident and he's recovering. And I'm paying for him to live and paying for his medical bills, so I'm paying more than half of his total expenses for the year. Because we're related, he qualifies under certain rules, and there's a couple more things you have to tick off to make sure he qualifies. But he qualifies as a qualifying relative, which qualifies as a dependent. So it's not just your children, it can also be people who you are, I think you don't necessarily have to be blood related, but I think it's through marriage or...
If you look on the back of your handout, it details the rules.
With that.
So there's 2 different categories. You can be a qualifying child,
Just under 18.
and there's rules, it's 19 I believe, or if you're going to school it's 24.
Right.
And then if you don't fit those requirements, you could also qualify as a qualifying relative. And those are a lot more broad.
Yeah.
Like you can have non-related people be your dependents,
Yeah.
as long as they're living in your house the whole year, they don't make enough income. So this is kind of interesting because when I was learning about these rules in college, I was right around that age limit for this. And so if everyone has their own exemption, an exemption is the same thing as the dependency, it's that person's exemption. So either you can claim yourself or your parents can claim you as a dependent. So it's kind of interesting to see how these rules meet, because I was looking at them and I went with my dad. We went to like whoever was doing his taxes at the time. It was some guy in his house just who does it on the side, and he was claiming me as a dependent. And I was looking at the rules. I said, technically I don't qualify as a dependent. So me and my dad had this little like back and forth in front of the tax advisor, like, I don't think I qualify, and he ended up claiming me as a dependent anyway. But it's kind of interesting to see if you look at those rules and think, at what point do you stop being claimed on your parents' return and you can start claiming yourself on your own return, which will be right around right now for you guys. So.
And the reason why people care about this is because an exemption equates to a tax deduction.
Right. Backwards?
Right.
Which way's backwards? This way backwards? Yeah. So you'll see on line 42, I know it's super small up there, but that's an exemption. It's a straight up deduction of taxable income.
It's $4,000.
4,050, right?
Per person.
Per person. So per person that claimed on your tax return. If we go to page 1, you'll notice that here, boxes checked and go, that counts the number of people counted on this tax return who get an exemption. So let's say again, my wife and I are filing a tax return. I get one, so you're gonna see a box in there for 2, and my wife gets one, so 1 and 2. And then let's say we have a kid, that's a third. That's why they always say have your, like, if you have a big taxable year, always have your babies in that year, because it's a little baby tax write-off.
Or like have a kid in December versus January.
Yeah.
Right, because by December 31st, then you would be able to claim that kid, even though you only had a kid for days.
Right.
That's good tax planning.
Good tax money.
That was the argument we had. My birthday is December 21st, so she thought the whole year I was 24. But anyway.
So, if, like, I'm 21, for example,
Congrats.
like, are you automatically a dependent? And now, I also knew something like, if you could be claimed as a dependent, but then your parent doesn't, there's also like a rule prohibiting you from claiming yourself. Is that true?
No.
No?
There's no rule that I know of from
Okay.
claim. So what usually happens? Let's talk
Okay.
specifically on high net worth people, right?
Yeah.
As you can see on page 2, or not even high net worth people, like kind of even normal income people. Exemptions. If line 38 is 156,000 and change, if it's more or less than that amount, you start to get phased out of exemption. So for a lot of my clients who make, let's say, an AGI of 2, 3, 10, $100 million, they're not going to get any benefit from exemptions, whether it's for themselves or children. But the children might be college-age kids or graduate students who have a side job or have summer internships where they get paid, and let's say they have more income than $10,400, which was the single amount that you would need to. Let's say it's $15,000. So it doesn't make sense for the parents to claim that exemption on the return because they're not going to get any benefit. So what we do is we file a tax return for the kid, put the exemption on there, like they can claim themselves, because I think what you're thinking is that if you claim your own exemption,
Yeah.
right, your parents can't claim it, and if your parents claim your exemption, you can't claim it, that's 100% right.
Okay.
So
Go ahead.
in your situation, it sounds like your parents qualify to claim you, but they don't, and
I
you're
think
wondering
so,
if you can
yeah.
in that instance, and I think you should.
Okay.
Just-
Zach, would you agree with that?
Yeah,
If they don't
always
claim
tell
you-
them.
Yes.
Because this happens every year. I have one client who has 5 kids. And one of them it goes back and forth as to whether or not they're going to claim their exemption. And without fail, one of them always claims themselves, and then I get an e-file diagnostic or an e-file reject that comes back saying, hey, somebody already filed your return, then they flag it for fraud, then we have to send it in paper, and it is a mess. So always tell your parents if you're claiming yourself.
Yeah.
Do us a favor.
So when you if I file my own taxes,
Yeah.
I can still not claim myself and my parents claim?
That's correct.
And what is the benefit in me claiming or them claiming? Is there like a net, like positive if I claim and they don't, or?
It depends if they can take advantage of your exemption. Let's say they're at a higher tax bracket and they can claim your exemption for whatever reason, they fall underneath the, before it starts getting phased
And
out.
that's the 150,000.
Right. So there may be more tax benefit for
Right.
them claiming you because they can knock off more income, which may drop them into a lower bracket. Now, if they're above it and they're not getting any benefit, right? If they make $2 million and they're not getting any benefit from claiming you, and let's say you have $15,000 of income, it would benefit you because that would be $4,000 minus 15, we pay at 11, dropping you significantly, lower income, lower
And
tax.
also look at the tax rate, because the deduction really is only as good as the tax rate it's going to offset. So if your parents are at a higher tax rate, it's a better benefit for them to take it, as opposed to you that's at a lower tax rate.
And
So-
sorry, last question. The $4,050 doesn't mean anything except it's just how much your gross adjusted income is. Like I'm not getting,
No, it's a deduction.
but do I get that in like a tax credit or like what?
It's not a credit. Just think of it, let's say you have $15,000, right? We get to line 37 or 38, whichever one you want, and you had a $15,000 W-2, right? Everybody understands what a W-2 is? All right. So on line 38, you have $15,000. what will happen when you claim your own exemption on page 1, you're filing your own return, claiming your own exemption. We're gonna take a straight up deduction, and that is now your income.
But then the tax rate is applied after that.
Yeah. You also get a standard deduction, which we'll talk about, which is 6,000 and change, which would lower this to another 5,000.
So a credit is applied after the tax, dollar for dollar, it reduces your tax due. A deduction reduces your taxable income, and then it's the tax rates applied. So you see the difference there. We'll talk about it more.
Exemption is just a fancy word for a deduction everybody gets.
Yeah.
For now, in 17.
Yeah, let's not get too attached to this
Yeah.
because as we'll see in a second, that's actually one of the changes for the new tax law
Yeah.
that passed in December. Exemptions starting in 2018 are gone.
So it's just this year.
Yeah.
But it works just like a deduction. So you kind of get this principle that it just acts like a deduction of income, not of tax.
Just to
Everybody
follow
cool
up
with
on
this?
that question of substantiation. So if you, like if you donate money, right, or like take stuff to Goodwill, whatever, you get like a little receipt. So you should just like safeguard that for just for the year or for like a long time.
3 years?
I'd say at least 3 years is the best
Okay.
practice.
And you don't have to submit that. It's just if you got all the
Right.
It's a 3-year statute of limitations, everything. Has anybody ever heard that phrase, statute of limitations? Is when, once you file the return, the statute opens, right? You got 3 years. The IRS has 3 years to come back and say, show me this. And after that last 3 years, unless there's fraud, which is a 25% under-reporting, they can't really come back and question. Yeah, I was just gonna say. U.S. people are taxed on worldwide income. So even if I'm a U.S. person and I have money in a partnership that's foreign, I still have to pay tax on any income earned on that foreign partnership. Worldwide income, so anything and everything.
I'm a little confused, like you said 25% fraud, I just don't understand the math
Oh,
of that.
so if there's fraud, which is reported, so say I actually earned $200,000, but I only reported $100,000, that's 50% difference. The IRS, the statute of limitations, then I believe is 6 years or longer. Maybe it stays open, I can't remember what the statute of limitation is for sure. But I know it runs longer than 3, it's like 6, 7, or infinite. It's one of those.
So if the tax you reported is 25% less than what you should have reported,
Right.
then yeah, that'll.
Then the statute never tolls, and the IRS can come back at any time and audit. But they have to have like reasonable belief that you want to report it and have information to back it up and all that kind of stuff. Usually you see that in like whistleblower stuff where you get a huge fraud issue.
Okay, question?
Yeah, I had a question about the U.S. person making money abroad. Is U.S. person include permanent residents?
Yes.
Yeah.
Okay. So permanent resident making money abroad also still has to report that in?
Yeah, if you're a permanent resident, it doesn't apply to non-resident aliens who only pay income on, only pay tax on income earned in the United States.
If you're a non-resident alien.
Right.
But if you're a green card holder, permanent resident, citizen, you're all the same. U.S. paying taxes on worldwide income.
For the rest of our lives, basically.
Until you
Renounce.
expatriate.
Yeah. Yeah.
That's something you really want to go through, but then you have to pay an exit tax, like that's a whole nother mess of stuff, man. That's like, we have a specific department at PwC that handles that, and it's not fun. It's not fun.
And what about if you have stocks, you earn income from stocks? How does that work? Is it only taxable once you pull out of the stock? Or is it-
Realized gains. Yeah, you're unrealized. So if you just have money in there and there's no buying or selling, right? You just own a stock and you're not buying or selling, you're just letting it ride, let the money ride inside.
Right.
It's only upon which you sell shares. So if that's considered realized gains and losses, unrealized gains or losses is, just like I said, you're just letting the money ride. Or accumulate, go up and down based on the amount of shares you own in the stock price.
Okay, so whatever you sold, you have to report.
Yeah, in the current year. And the whole goal with that is like having a balanced portfolio. You always hear like rebalancing my portfolio is to be able to, if you do have gains that you want to recognize in a current year, have also those stocks that you can recognize losses in so that it kind of teeter-totters out. So whatever gain, let's say you sold a stock and you have $100 gain, hopefully you'll have something down here that you can sell for like $50 or $100 of loss so you can kind of get that balance back out. You'll see that very often. There's always big sell-offs. That's why if you ever watch the stock market closer to December 31st, there's always a huge sell-off to recognize gains and losses, and then a huge buyback come January. Fun stuff, right? Oh, sorry.
Do you want
Oh,
to
gains
go
and
on?
losses are on page 1 if you look in, here, capital gains and losses is line 13. It's reported, so just as also as another tip, the 1040 page 1 and 2 are just like the first cover pages of a return. All the partying goes on in the back. Just like any good house party, right? The best part of the party is always in the back, in the schedule. So Schedule A is for all of your deductions. Schedule D is for all your capital gains. Schedule B is for your interest and dividends. There's hundreds of pages on the back of these returns.
If you need them.
If you need them. Page 1 and 2 are just a consolidation of everything that's happening on in the cool party in the
The
back.
totals.
Yeah. Just as a general FYI.
But if you have a plain vanilla return, then if you have the W-2 or some interest, your return will not be very thick. Right, so like don't be scared by hundreds of schedules, hundreds of pages type of thing. I would expect your return to include these first 2 cover pages and then maybe a few other supporting schedules, and that's it.
Or a statement.
Yeah.
Okay. So this one?
Oh, sure. So does everybody live in the district? No? Oh, great. So I went to school at GW. I wasn't chosen to come to Georgetown. But I'm originally from North Dakota. So while I attended GW, I'm still a North Dakota resident at that time. Because just being a student in the district doesn't necessarily make me a district resident. Because there's different aspects of like residency and tax residency. So let's say I'm no longer living in North Dakota. This is after, right? And I'm a graduate student here at Georgetown. I go to school in Georgetown. I have a job in Maryland, but I live in Virginia, right? I have a home in Virginia. Where do I pay taxes? Virginia, absolutely right. So in this small area, we have a reciprocity agreement between the 3 different taxing jurisdictions, which says you don't have to withhold taxes. Let's say you just have a normal employment, right? Normal employer, PwC. PwC doesn't have to withhold taxes in Maryland. They're going to withhold taxes for me based on Virginia. And the same thing would happen if I lived in Maryland and worked in Virginia. Or if I lived in the district and worked in Maryland. You know what I mean? So it's based upon where you reside. Your home is where you go to bed. Not necessarily. Oh, cool. Good question. So have we all gotten a W-2 before? Right? All right. So a W-2 is going to be broken up into 2 columns. One's going to tell you what your income is, and the other's going to tell you what taxes you've paid. Taxes that are taken out of your paycheck on your behalf by your employer is called withheld, right? They're withholding tax. What happens is your employer then goes ahead and pays that tax on your behalf to the federal government. That's what I mean
And
when
to
I
the state.
and to the state, sorry, and to the state. Yeah, if they pay tax to the Fed, just assume they're also paying it to the state. That's withholding. Does that make sense?
It's like when they pay your taxes for you as
Yeah.
opposed to you
Exactly.
having to do it.
Yeah, so it's like they're withholding agent almost, right?
Right.
And so this was the means that the IRS came up with to make sure that individuals remitted their taxes regularly, right? Because they know that if they left the compliance to individuals who don't understand a very complicated tax law,
They just won't
that
pay.
the IRS or even the states won't necessarily receive their revenue, right? Because that's how they get their revenue to run the state. They won't get their revenue regularly. And so instead, they put that burden on employers to say that if you have employees, then part of your responsibility as an employer is to remit withholding, tax withholding, to the applicable jurisdiction, IRS, state, whatever it might be, on behalf of the employee, right? That's not to say that you don't have to file taxes, right? Because it's simply they're withholding agent for you. And so on your taxes, right, when you file taxes, then you have to claim a credit, if you will, right? A withholding credit for what's already been remitted on your behalf, right? And if your employer has over withheld for you because you had more deductions, for example, then you can get a refund, right? If conversely, your employer has under withheld because you had some other income in addition to your W-2 income, then you have to pay in more taxes, right? So that's the mechanism of withholding.
Yeah.
So if you're working like multiple odd jobs kind of, and like some are withheld and some aren't, you still kind of like file because maybe one of them didn't withhold kind of.
Right.
Okay.
Report everything, see how it shakes out. If you're making a lot of money on a job that you know doesn't withhold, then you should probably look into things that are called estimated taxes. But my guess is that you're not making an exorbitant amount of money.
That
for
doesn't have
somebody.
withholding.
Right,
Yeah.
that doesn't have withholding.
So when it says where you work, so work in Maryland or Virginia, is that determined by your employer or by their location?
Employers can map you to different jurisdictions. Like I have people like that work for a very large corporation that's headquartered in California, but
Right.
they're mapped to people to Virginia because they reside in Virginia too. So they just, it all depends, but it's usually where you go to work.
So I worked for a company out of New York, but I did all my work in Arizona. And
How
so
do they withhold?
I think under New York law, so my question is, can I change that? Because Arizona's less state tax, right?
No, by now you usually have to choose as to where you're gonna
This was in
reside.
2017?
Yeah.
Summer 2017.
Yeah, but you didn't live in New York at all?
No, I never went to New York.
Yeah, so that might be something, I would actually take a look at the New York rules. You can actually
Yeah.
Google it and
Okay.
probably New York form will pop up. There are some states that will permit just a refund. So if you
Right.
were incorrectly withheld in a state, and it sounds like you may have been incorrectly withheld in New York,
Okay,
you can file a simple form to explain that you were incorrectly withheld,
okay,
get the money back that was withheld, and then file taxes in Arizona where you actually live
right.
and pay tax there.
Right.
Right, so you have to pay out of pocket, because nothing was withheld in
Right,
Arizona.
right.
Pay out of pocket for Arizona, wait for the refund to come.
Yeah.
Don't give it any hope.
Yeah, New York's rough. Sorry.
So kind of the rate that they use is dependent where you're living? Like the
Yeah.
tax rate at which they
With,
withhold.
they're withholding, correct.
I see.
And New York will withhold, they will withhold at a much higher rate than say DC. I forget what New York is, but I think it's like
Pretty high.
11%. A lot of jurisdictions use the concept that you reside there with no intention to leave. Like
There's a lot of
establishing residency and where you live is a multi-factored facts and circumstances case.
Like tons of different factors, like where do
Do
your
you-
kids go to school?
Do you have a license there?
But like,
driver's license.
what does summer internship qualify? So like if you're only there for 3 months?
No, were you intending to live in New York for the foreseeable future?
Arizona, no.
No, then yeah, I wouldn't say that's intended where you're intended to live. Your permanent residence would be, you're a graduate student?
Yeah.
Or do you own an apartment or do you have an apartment or home
Right,
in DC?
in DC.
But you plan on staying here for the foreseeable future?
Yeah.
Then I would likely say that you're DC
Okay.
resident.
Okay.
Probably.
Okay.
So, this is a fun, complicated thing. In both New York and DC, you're going to have to file what's called a non-resident or part-year return. It just depends on what the state calls it. Usually it's called NR/PY return. And you're going to have to go ahead and file taxes in that state based on the income in which you earned in that state. Everybody with me? Earned a W-2 in New York, you got to file a return in New York. Earned a W-2 in DC, you got to file in DC. And you may have to pay taxes on those returns, right? You're going to end up paying a specific amount of tax based on the income that you earned. You had withholding, you might get a refund. But whatever tax you paid, you will get a credit for on your resident state return. So when you go, if you have a situation like this, you might want to go to H&R Block or TurboTax, use one of those instead of trying to pencil it out. Just as an FYI. You'll get a credit on your resident state return for the taxes you paid in other jurisdictions. So all the returns are going to be created at once, but DC and New York for your Massachusetts go into Massachusetts kind of, because you have to take into consideration what tax has already been paid in other jurisdictions.
Right, so I guess maybe said another way, right? Because this is a very classic scenario for
Yeah.
students, and it gets very confusing, right? So that's why I wanted to park here and spend some time, because I know we've done these presentations in the past. This has been a very popular discussion point, right? So as a resident in the U.S., we pay taxes at the federal level. That includes all of our income from worldwide sources, right? Your resident state will view you very similar way, right? Wherever you have established your tax residency. Right? So this goes to the questions, right? Facts and circumstances. Where is your permanent residency, right? If you're a student in DC and you're not planning to stay in DC, right? If you're not a graduate student, you're just a student here, maybe that's not the best permanent residency. right? Maybe your parents' address is your permanent residency, because that's where you still have your driver's license, where you still vote, where you still have all of your attachments, right? Like in Boston, for example. So if that's the case, then Massachusetts will view you as a resident, and you will file a tax return in Massachusetts as a resident, which will include 100% of your income. Just like the federal return includes 100% of your income.
In most state returns, the first number you're going to see on there, they're going to start with, is going to say federal AGI. They're going to go ahead and start with all of the income that was already calculated on your federal return and use that as a launching off point to start your state returns.
Exactly. So then after that, right, so that's base case. Then after that, it's very common to have income earned in another state, right? Because of summer internships or whatever it might be. And if that other job withheld on your tax or withheld on your income and remitted that to New York, for example, then in that state, then you will file as a non-resident because you weren't a resident there, right? It is possible to have a non-resident state filing, right? So if, in our example here, if you're a Boston resident, Massachusetts resident, but you earn income in New York, then you file as a non-resident in New York, right? But wait a minute, you say to yourself, the same dollar of income is being taxed in two different jurisdictions, right? Because your Massachusetts is 100%, just like the federal return is 100%. And now you're also including a portion of that 100% on a New York non-resident tax filing. That seems
You were there for your internship.
Right, you're there for the internship. That seems terribly unfair, right? So there's a mechanism to try to cure for that. And that mechanism is what we just described, meaning that the taxes that you pay in New York, for example, can be claimed as a credit on your resident state return to reduce the impact of this double taxing of the same dollar in two different states.
Right. And that's a dollar for dollar reduction generally in tax because you already paid the tax.
Yeah. All right, so maybe we should move on.
Yeah, unless someone's outside, we can stay, but if someone comes in.
No, no one yet. Okay,
great.
Any final questions on that before we move?
And that's like you've been in New York and DC and wherever your dollar state is, you would make sure that it only files like $1 per state kind of, by only claiming it all on your state form.
Can you rephrase your question?
Yeah, I'm just confused. Would you just claim all of it on your state form regardless
Your
of
resident
your
state form.
job in DC or New York or wherever? Or like even if you had multiple?
Yeah.
Okay.
Yeah.
Yep, that's right.
And they should be.
Yeah. Yeah. All right, so the next one we're going to gloss over because we spent a lot of time on exemptions already.
Yeah.
All right, so let's just move on here.
And they go away in 2018 anyway.
Yeah, exactly. Okay. Different types of income. So we've touched upon some of these and where they go on a 1040. Right, so page 1 of the 1040 is the income section. So we talked about W-2s, interest and dividends. That's often where you have cash and you put it in a bank account, for example, and it earns interest, or you stick it in some kind of brokerage account and you get some investment earnings, right? The brokerage firm, for example, will send you a 1099, and that's how you'll know what needs to be included on your 1040. Okay. Scholarships and grants, we actually talk about in another slide. That's probably a popular one for everyone to understand the taxability of that. So we'll touch upon that. Retirement plans we talked a little bit about earlier. Gains we talked about. Is anybody here self-employed?
Does anyone drive for Uber?
Lyft, Ola, anything?
Because that would be self-employment income.
Right, okay.
PwC, but
All right, so we don't need to talk about that. Okay. I guess, are there other forms of income? Again, we'll touch upon scholarships and grants in a moment here.
So as a Georgetown employee, I get for grad school tuition reimbursement.
It'll be cooked into the W-2. Yeah, it'll already be taken. They'll already take it in consideration for your W-2.
So that's already listed in
Yeah.
income. Okay.
So I'm tax exempt because I'm doing it for my job, so does that one be noted? Like, I got a whole form and I did a whole thing.
I'm not. Do you know specifically if she's exempt from specific amount? Oh, so this is like.
This is what the tax law is trying to kick out.
Yep, I remember this. It comes in for graduate students who get tuition benefits, and you get a knocked off of tuition because you're working for them, right? Graduate
Yeah.
students. It's used a lot in like MIT, Caltech, things
Okay,
like that. I don't know.
Okay, that's fine.
My guess is that you're going to get a separate form or something to indicate portions of tuition that were not included as taxable income due to your status as a university employee.
Okay, thank you.
You should, yeah, ask your payroll department specifically if they'll give you
Okay.
anything.
So here are kind of the exceptions. So typically scholarships and grants are tax-free. If you're a candidate for a degree, which you are, and that money is used to pay for tuition and required fees and required books and things like that. But if it's not required, like for example, room and board is not, if your scholarship, a piece of that's room and board, that's not tax-free, that's considered income. Any questions?
So what about a research grant? It wasn't used for tuition, but it was used for like a research project.
So for
But it was
those,
from the university.
if amounts received are for research or teaching, so basically they're kind of hiring you to do research.
Yeah.
This is probably where your stuff comes in too.
So in that case, it's treated as, it's not tax-free because that portion of your scholarship is like they're hiring you as an employee. And they're saying your payment is a reduction in your tuition.
But I don't get a W-2 for that.
You'll probably get a 1098 that'll say something like that.
Probably.
I don't know.
Should we ask Georgetown HR then at that
Yeah.
point?
Yeah.
Ask
I'm
payroll
not sure
or
the
HR.
form. I don't think you'll get a W-2.
And then there's a spot for that in the 1040 where you put in like grant.
Mm-hmm.
Yeah.
Okay.
I think you just include it on line 1.
They'll give you a form. Go to your HR or payroll department, probably both, and ask them specifically. They should have proper training on how to treat, because you guys aren't the first ones to ever have this, right? They're gonna have specific instructions on how to help you. We're just talking kind of broader strokes on scholarships, grants, and things like that. So with very specific instances, I would definitely reach out to HR and payroll.
I guess wanted to make sure that I'm thinking about this right. If I'm a graduate student here, they pay my tuition, that's not taxable. They
Correct.
pay me like a stipend. like a
Stipend
living
on top of
stipend.
that.
Yeah, that would be taxable.
What's the stipend for? Are you doing additional research
No.
or anything like that?
Just living expenses?
It might, if it's like
Yeah,
for
I'm not
room
a
and
TA, I'm
board.
not a research assistant, it's just paid out like a scholarship, except for they'd give it to me.
It's likely taxable.
Yeah.
Unless, again, double check with your HR and payroll people. Because HR and payroll will be or your specific department, because the finance director for whatever school you're working for will probably be able to help you navigate the taxability of whatever portion of your amount you're getting of that stipend is for room and board, and just be sure. They should be able to help you.
I just have a question, 2 questions. One, what is with like stipends that are from other countries? Are those also? I mean, this is also
Maybe.
I just started thinking about, so I'm like. And then the second question would be, if you have a tuition waiver, is that the same? Is that considered like a?
Is that what you get too as a tuition waiver?
Yeah, they just
Yeah.
like I go into my Access account and they're like $11,000 gone. I'm like,
Yeah.
I think if it's a tuition waiver for additional services that you're providing, then it's like you're being paid to do those services. So that would be
mine's just a
taxable.
benefit of my work.
Yeah. And again, that might come if you work for the university also and get a W-2, that might be in whatever portal you use to access your W-2.
That'd be GMS for most people in Georgetown.
Main takeaway, if you have very specific instances, talk to payroll, talk to HR, talk to the school in which you receive the money from.
No question here.
So if I get a scholarship and it's not like sent to Georgetown Financial Aid, it's sent as a check to me, does that count as like taxable scholarship?
Depends on what the scholarship is used for. If the scholarship is used for tuition, qualified educational expenses, then likely not. If you not taxable, sorry. If you use that specifically for books or maybe a keg, I don't know, then that would be taxable.
Okay, so but if all those outside scholarships are still less than $10,000, I wouldn't have to worry about it.
Why do you pick $10,000?
Because then I wouldn't have to file taxes to begin with, right?
Oh, yeah,
Probably.
yeah, you're probably right.
Any other questions?
All right, cool. Can you go back to page 1 of the 1040? Cool. And so these are adjustments. Levi kind of touched these already. I think the most important one, no one here is self-employed, right? All right, these two. You get a deduction based off of, and I kind of misstated this earlier dealing with your IRA. But if you have self-employment income, you can contribute to a SEP, which is a self-employed pension, right? Is that what the SEP stands for? I think it's self-employed pension plan. Anyway, it's a same thing 401k for people who are self-employed. You get an adjustment. These are called adjustments. You can call them above the line deductions. It's the exact same thing. And they're for very specific expenses. The one you'll most likely use now, maybe, depending on if you're paying back your loans or in the near future, is going to be your student loan interest deduction. And we talk about this a little bit more specifically here in a minute. I think there's a whole slide dedicated to it, right? Anyway, if you're paying back student loans, you can deduct the portion that is attributable to interest, right? Student loans work similar to like a mortgage or any other type of loan. It's going to earn interest, right, as it goes on, but there's going to be a portion that's principal. Small portions of each payment will be attributable to principal, less right away, more to interest, and then that flips as the payments continue to progress. So the amount you pay to interest, you can take as a deduction. And that's a deduction from income. So after line 22, you play with all of your income, you get your total amount of income, then you can deduct student loan interest, right? That's a dollar for dollar reduction of income, not tax. And the credit is actually phased out, so I think it's $80,000 and $160 for a joint, right? So if you make more than $80,000 in a year, you won't be able to deduct any of the student loan interest. If you make less, you'll get to take some, but not all. There's a slow phase out. I think the phase out starts at 60 and it's completely out at 80, or 140 if you're married and filing jointly, and out at 160 completely. And the the deduction is only $2,500. So let's say you have $500,000 of loans, you're paying back a lot of interest, you're likely going to have more than $2,500 worth of interest. You can still only take $2,500 of interest. That's going to be the one you guys see most often. If you're doing an IRA, you do an IRA deduction.
If you move for a job, moving expenses, you can.
Is there a 401k deduction?
That is going to be deducted right out of your W-2.
Yeah, out of your taxable wages. Are there any that you think are important to note?
Above the line?
No. Yeah.
No, I mean, there's this little one, educator expenses.
Oh,
is
yeah.
not a significant deduction. I think it's $250.
Yeah,
And so if you are a TA or where you incur expenses on behalf of your class, then you can deduct up to $250. It's not super significant, but why not if you can do it?
Right. Anybody divorced or been paying alimony? If so, you can deduct it from income here. Just as an FYI.
Yeah. That's why people actually care. This might not be for this population here, but in general, right? So there is a big difference between paying child support and alimony.
Yeah, child support, you get nothing for it, except just the love of your children long term.
Alimony, you get a tax deduction.
Yeah, careful pricing. That's why there's no box. Right? That's why there's no box. Well, there is reserved for future use, so you could possibly just like write it in child support, love, affection, and try to put a value on it. Infinite, just put 0.
Next, I think, is standards and itemized.
Yes, so this was a question that we had earlier, so we can dive into this a little bit more. Right, so we talked about deductions and how deductions are good things, right, on a 1040 because they reduce your income, and your net of your income and your deductions is then what is taxable income, which then is against what your tax rate is applied. Our 1040 has different kinds of deductions, right? And so what we've been talking about so far are these above the line deductions, right? The ones on page 1 of the 1040 that are really quite valuable, right? So people call them above the line deductions. There's a host of other deductions that you might hear called itemized deductions, right? Itemized deductions are on Schedule A, right? This is one of the supporting schedules to the 1040. And there's also this thing called a standard deduction, right? So now we're going to focus on these two things and how they work with each other. So let's start with the standard deduction. The standard deduction is what the IRS gives to everybody. right? They just assume that there's a cost to live, right? There's a cost to stay alive. There's a cost to buying food. There's a cost to doing laundry. There's a cost to staying alive. And so they reward us for staying alive, right? And they give each of us a standard deduction. So for 2017, for a single person, that standard deduction is $6,350. And you can see the amount for marriage filing joint, right? And so how this works is that just like any other deduction, you take your income, you minus your deductions, and you get to taxable income, right? So that's pretty good, right? That simply by being alive and doing nothing, right? Just supporting yourself, right? Staying alive, each of us gets a standard deduction of $6,000 as a single person, right? There are ways to increase your deductions through Schedule A itemized deductions, right? So the tax law says that if you incur certain other kinds of expenses in the course of just staying alive that are deemed to be tax deductible expenses, and if those expenses exceed the 6,000, then you take the higher, right? You take the itemized deductions. You don't take both, you take the higher of the two, right? So in 2017, I should say, for the 2017 tax filing season, which is now, then these are very common deductions over here on the right that are considered itemized deductions that are tax deductible. So you can see that these types of deductions are expenses that regular people incur to stay alive, right? And to be charitable, right? So let's take a quick look. State taxes paid. We talked a whole lot about state taxes. Right? If you pay state taxes because you earn money in a state, that tax that you paid is deductible on your federal tax return.
It would be in the amount you had paid.
Yes, the cash tax paid, taxes that you paid. Or said differently, the withholding, right? Because again, your employer withholds on your behalf. So the withholding is a tax deductible amount on your federal return, the state withholding. Home mortgage interest, right? It's a popular one, especially in this area. Houses are expensive. Property tax on your house, your real estate, right? Personal property tax. Some states like Virginia have a car tax, right? So that is deductible. Again, tax expenses incurred to live, right? Charitable contributions. That's going to be a little bit more discretionary, but the IRS awards a deduction for charitable contributions, right? And tax prep fees, right? And there are several others, but these are just very common ones that we see.
Anybody? Oh, go ahead.
No, go ahead.
I was gonna say, anybody own a home? You're all gonna use the standard deduction. Congratulations.
Right?
You don't own a home, you don't own property, there's gonna be very rare, is anyone giving away $10,000 or more to charity? I'm sorry, $6,000 or more? Anyone?
Maybe in the future.
I'm just saying right now, this year, tax filing, you're gonna get the standard deduction.
We're not going to dissuade, right? So it's good to be charitable, one or the other.
Just like a teeter-totter, either up or down.
So it's
Yeah.
like, you'll see a commercial like, donate to this, it's a tax deduction. It's only a tax deduction if you're itemizing.
Right.
Otherwise, it's not deductible.
And most of us are itemizing unless we own a home.
Nope.
Or most of your
Oh,
hitting the standard.
Oh.
Because a lot of these deductions relate to home, like
Yeah.
home mortgage interest, personal or property tax.
Oh.
So if you own a home, then you're paying a lot more of these types of deductions.
And if you
So-
don't own a home, you most will, in very rare situations, unless you're extremely charitable, be taking the standard deduction.
Yeah, now I remember my parents running around collecting all the receipts for everything they were donated and everything, because they're trying to itemize every little thing, which I don't know if that's effective or not, but I think they're probably doing itemized deductions then at that point.
Right.
Yeah, but yeah.
Keep a receipt for whatever you donate, whether it be to Goodwill or to the local booster club or whatever it is.
Standard's easy, there's no paperwork, it's just you get that amount.
Yeah, no substantiation, right? So the IRS gives us these standard deductions. Yeah.
So for next year, the standard deduction is going to be higher than the requirement to file, right?
Well, they're,
The requirement to
They're
file
probably
is
gonna
still
change that,
10,000,
right?
or?
I'm guessing.
I imagine it will go up.
Yeah.
I mean, the requirement to file is basically your exemption and your standard deduction.
That's how they came up with the
Combined.
test.
So next year, those two will be higher, so the requirement will be higher.
You're asking the same questions we're asking, because there's no guidance yet. There's not even guidance really. I looked it up based on our conversation on the W-4 on how to do a proper W-4 going forward.
For
The
exemption.
IRS has delayed their rules and are allowing people to use the similar old W-4s, but instead of calling them exemptions, they're called allowances.
Yeah.
There's no information out there, man.
But so we have noted here in 2018, right, this is really significant. This was one of the big changes to the tax law, and it will affect a lot of us, right? Because now the standard deduction is skyrocketing, right? For single people, $12,000. That's a huge amount, right? Huge. So we think about the impact here. Like, this is actually part of President Trump's tax code simplification. I put that in quotes 'cause in my opinion, it's still not simple, right? But this is one way to spin it, to say that because of the increased standard deductions, the number of people in this country that will actually itemize is going to plummet. Because a lot of people that would have itemized because of these things here will now take the standard deduction because the limits have been boosted. Right, so now the complexity of 1040s is going to drop because a lot of people won't have to deal with any of this stuff here. They're just going to take the standard, right, the higher of the two.
And this excludes people on either coast. If you think about it like big picture, either coast will end up probably still itemizing, especially if you own a home, because home prices are generally higher on either coast, right? Los Angeles and DC, New York, whatever. It's more, this is more targeted, as you can kind of see, towards that whatever else is in the middle, you know? You could call it flyover country, whatever you call it, where home prices are lower, mortgage rates are lower, less mortgage interest is paid, property is cheaper, so less property tax is paid, so the odds of you itemizing go down and down and down.
So then, do people sometimes compare whether it's more beneficial for them to do standard or itemized?
Oh, everybody should be comparing. I mean, like, this is a calculation that everybody should run when you're doing a 1040. Because you want to get the biggest deduction.
Right.
Yeah, no, obviously.
Yeah, you don't want to pay more taxes.
Everybody likes their own money.
Yeah.
Right,
Keep as much of it as possible.
Exactly, yeah.
Property tax, is that property tax for homes, including homes, and, you know,
Homes, second homes,
vehicles, second
vehicles.
Yeah.
Any kind of property tax, really.
Land,
So
you just want
100% of it is deductible.
In 2017.
Yeah.
It changes in
Next year,
2018.
it's capped.
So 2018, we're not sure.
10,000.
Well, there's a 10,000 cap.
Oh, there's a 10,000 cap. Okay.
Yeah, a lot's changing in 2018.
That's good.
All right,
Anything else?
that's it. Oh, this is still new. Okay, so I think, right? Okay. So we've touched upon this, right? Talking about the difference between credits and deductions. That's all right.
Sorry about that.
So of the two, right, credits and deductions, they both are good. They both will reduce your tax liability, right? But of the two, which would you prefer to have? If your goal is to pay as little taxes as possible. What do you guys think? Wait, I heard deduction. What else? We hear credit too? Deduction. Okay. So of the two, if you had a choice and your goal is to pay as little tax as possible, you actually want a credit. Because a deduction simply reduces your income before the tax rate is applied. So it's tax effective, right? So if your tax rate is 10% for easy math, and if your deduction is $1,000, then your tax benefit is 10% of $1,000, so only $100. But if you have a credit of $1,000, and let's say your tax liability is $1,000, then the credit is a direct dollar for dollar offset. So it brings your liability down to zero, right? So that's why it's so beneficial. And so there are some, right, so we've spent quite a bit of time talking about deductions. We'll go into credits pretty shortly here, education credits, right? These are awesome tax benefits, right? So if you qualify, definitely take advantage. I did when I was a student. They were awesome. Right? Dollar for dollar offset, really fantastic.
Okay, so this is, look at the different tax rates. When you actually get to the tax, and you have to compute, there's two different ways to do it. You can use a tax table, which will basically tell you exactly, it has different breakouts every $50, and you find where you fall in that, and it will say you owe this much tax, and you just put that number in. Or you can use the worksheet or these tax brackets, you've probably heard. And you just kind of, it's a little bit more math intensive. You kind of calculate it. It doesn't tell you the exact amount, but it's pretty simple. Basically, you figure out which bracket you fall in. So if you make between 91 and 190, then you start with a base of 18,700 of tax, and then you just take plus 28% of the amount of income you have above the lower part of the bracket. Does that make sense? So you just add 18 plus 28% of that difference. And it works the same for every bracket. So there's two different ways to do it. They won't be the exact number both ways, but they'll be pretty close.
Does everybody get that, the whole progressive tax structure?
So this 18,000 is
Tax on $91,900 of income.
right. So it's just looking, so each bracket is taxed at a different rate. So if you're in like the 33% tax bracket, that doesn't mean your entire income is taxed at 33%. The first 9,000 is 10%. The next, whatever amount is 15%. The next is 25. It's a little confusing.
It works its way up. It's progressively more tax based on the more income you earn.
So if the limit for filing taxes is 10,000, then what's the first bracket useful for?
So if you are filing, that 10,000 is still taxed at 10%. I see what you're saying. Like if you make less than 10,000 and you don't file at all.
Right.
But if you are filing, that first 10,000 is still only taxed at 10%. So it is beneficial.
Okay.
This is the amount after deduction. So let's say you actually had $20,000, and after deductions, you still have $10,500 left, which is $100 above that threshold. Then you still have to take into consideration these tax rates.
So that's just how you actually calculate your tax. So these are the rates for if you're single, and then these are the rates and brackets if you're married. Which nobody is. So.
I think we talked about that a little bit in the beginning.
Yeah, this is kind of like just the concept of, well, if you're overpaid, you'll get a refund. You can elect to apply that refund to next year. So you don't actually get a check in the mail, you just apply it to next year's tax.
I think most people, if you are due a refund, take the refund.
Yeah.
Especially if you're a W-2 employee.
Right. Or you might have to pay at the end. Earned income tax credit.
Anybody have any children? No children? No EIC. That's really how it goes.
Well,
Basically, if you make
$500.
if you make a certain amount of money and you have children, you can take advantage of the earned income tax credit, which is trying to help those who have children and aren't making, are above certain lines of income here, which are pretty low. Even for if you take most people out of their first year of college are making this amount, if not more, in this area. So I mean, it's hard. You phase out really fast, but. Yeah, it's trying to help people with kids who don't have high earning positions. But that's really it. If none of you have children, for the most part, you might be able to take advantage of the small EIC, even if you have zero, but you make very little. So look into it if you fall into that bracket. But generally, no kids, you're not going to get advantage of it. Okay, these are the two credits that they were talking about when it comes to educational credits. And it's easier if I talk from back here. Think about the one on the left-hand side as undergrad, and the one on the right-hand side as post-secondary education. So education for your jobs and graduate stuff, right? Am I saying this correctly? Mm-hmm. And the left-hand side is stuff when you are in college. So this is up to 4 years of qualified higher education expenses. So this comes into anybody here for undergrad. How many undergrads again? This is undergrads, okay? Graduates, you are on the lifetime learning credit on the right-hand side, okay? So they do phase out. So if you are an undergrad, your modified AGI, your ability to take this credit phases out at 90,000. So it starts at 80,000. You get less credit. So the total credit is up to $2,500, and the credit is per student. You get up to $2,500 at $79,999. Once you hit $80,000 and above, that credit starts to reduce. So let's say at $85,000 is probably someplace in the range of $1,700 or less.
Is that number for income?
Yes.
Okay.
So modified AGI, adjusted gross income, the higher the AGI, the more money you make, the less credit you get. Same thing on post-secondary education. As you see, the phase out is much lower because they're thinking, hey, you might be working, or you should be working while you go to school, FYI. We're going to phase you out much lower. Go
What
ahead.
happens if you're making less than 2,500 in the first place? Like,
You're making less than what?
2,500 in the first place?
Is it a refundable credit?
Yeah, I don't think so.
Yeah. So there are things called refundable credits, like you get, like the earned income tax credit is refundable. So even if you don't have any tax, but you still qualify for the earned income tax credit, you can still get a refund. Does that make sense? But the American Opportunity Credit is a non-refundable credit. So even if you still had to file, but you have no tax, and you qualify for the American Opportunity Credit, you can't get that money back.
Oh, they won't give
Yeah.
you the.
It's not.
There's
It's
no
not.
government subsidy.
Yeah.
Yeah, so like if you had a tax liability of $1,500 and the credit is up to $2,500, then you would only get
Yeah.
$1,500.
It's only 50. You get zero back, but you pay zero.
So you need to have more
A
tax
liability.
due
Yeah.
than 25%.
You got to have tax due to get to benefit.
Yeah.
Or I mean, even if you only have $1,000 worth of tax, it's still you pay nothing.
Yeah.
Wipes it out.
Oh, that's nice.
Yeah.
Right. And this is for. Oh, go ahead. Oh
So
yeah, go for it.
you mentioned that earned income credit was refundable.
Yeah.
So if I make less than, wait, could you go back to earned income?
Yeah, there's some other qualifications that are required to get this.
Okay.
Yeah.
I don't remember this off the top of my head, but they're pretty restrictive.
Yeah. She mentioned the phrase, government subsidy. This is really meant to help people who are in a bad spot, not earn a lot, have some kids. They're trying to give them a little bit of credit. You may qualify based upon your. It's a rarity, not necessarily a rarity. Any software you use, whether it's TurboTax or whatever, right? It's always going to optimize for EIC based upon your filing status and the number of dependents you have. You would have to tell it not to. And if you could get it done at like H&R Block or Jackson Hewitt or wherever, they're always going to optimize for earned income tax credit because it's a multi-step test.
I'd say if you're interested, just Google it.
Yeah.
The qualification rules will pop up very quickly. And so you can just tick down through the list and you'll see pretty quickly if you're in or out.
Does that refundable portion make sense though?
Yeah. For
Like-
people that qualify, it's really, really amazing for them.
So you're-
Oh yeah.
Because they really need, and it's the population, the benefit population that actually really
Yeah.
needs that cash.
Not only are
Okay.
you not paying tax, but you're getting
Yeah.
payment back. They're
Yeah.
paying you.
Could you imagine raising 3+ children on $53,930
In DC,
in DC? Anywhere. I don't care, anywhere. That's crazy, right? The least we can do is give you $6,300,
that's tough.
right? Does anybody have any questions on those two? If you have specific, you can Google. Jen keeps saying Google the form. Google the lifetime learning credit. Google the American Opportunity Credit. Make sure you qualify. If you're preparing your own tax return, make sure you have a 1098-T, right? If you do, before you file your tax return, ask the university if you didn't get one. It's a 1098-T for tuition and qualified tuition expenses. Make sure you have that form before you file. And most software and most preparers will optimize for these credits if you qualify.
Yeah, the IRS also has some really helpful publications. So if you go to the IRS website, you can search for the publications by just typing in key search terms and they'll pop up. Or even if you Google it, the IRS publications might even come up in the Google search. They're written actually in very nice English, regular English, right? They're not very tax code heavy. And they're organized, in my opinion, in a very organized way. And so there should be publications specifically on education expenses, including credits.
For sure.
There's also the Hoya Taxa, the student group that help other students do their taxes, and they have 2 more workshops coming up where they'll sit down with you and word for word go through your taxes with you. So that's on March 20th. And April 3rd, just email hoyataxa@gmail.com.
You guys like those wordplays? Hoya Snacksa, Hoya
We
Taxa.
have guts, we have germs, we have just all these acronyms to mean all these things. So
There you go.
they're clever. But yeah, hoyataxa@gmail.com.
And then the lifetime learning credit is like after undergrad, we do that kind of.
Or if you're going back, say like, I don't think you don't get to take expenses if you're trying to advance in your job, but like say I'm an accountant and I want to go back to school to be a lawyer. It doesn't count for that, but say I'm an accountant and I want to be a better accountant, that would count. You can't go to a different job or like a different profession and use it that way, but you can improve within the job you're in.
And that's when you would also file the 1098T.
The 1098T is the form that the school will give you.
Oh,
To help
and that's
you.
for
Sorry,
the
that might have been
American
confusing.
Opportunity credit, or is that a separate?
It'll be for both. Whatever
Oh.
tuition, whatever qualified tuition expenses you pay for will come out in a 1098T.
That'll
I
tell you
see.
how much you paid in tuition.
Yeah,
It's like another worksheet.
it's another form, like a W-2.
Oh, and then it's also the tuition form. Okay.
Yeah.
Yeah, there's like information forms, there's just forms you fill out.
Right.
Does that help?
They're both information forms though. The 1098T and the W-2.
Yeah,
They're
Reporting,
informational,
yeah.
but they also are necessary so that you know what to even put on your tax return.
That tells you the
Right.
numbers to
Yeah.
use on your tax return.
Right, because the IRS, right, without these types of forms, then you could put anything on your 1040, and how would the IRS know that that's accurate,
Right.
right? So the IRS came up with a mechanism to say that the counterparty, whether it be the school that you're paying tuition to, right, or your employer they provide performing services for, right, they will issue you a W-2 and also send a copy to the government.
So the government
And so they
matches.
match,
And make sure you put the same number.
That's how they catch people doing fraud. but
right, exactly.
CP2000.
So something to keep in mind with this, and correct me if I'm wrong,
No.
but if your parents claim you as a dependent, your parents, and then you're going to school, your parents can then claim this credit.
Provided that they qualify under the income limits. I think,
Right, provided if they qualify. But you can only get 4 years of benefit for this credit.
Correct.
So you might think, oh, like, you don't know what you've done because you might be filing your taxes for the first time. Make sure your parents, or double check with them, say, have you claimed this credit already? Because you get 4 years of benefit, that's it, and they might have already used it. If that makes sense. Do you have a question?
Yeah, how do they track that 4 years? Do they see that it has to be done sequentially, like 4 years in a row?
I don't think it has to be done
It
sequentially.
doesn't have to be sequentially, but they do track it because on the form where you claim these, I forget the form number off the top of my head, you do have to list person and social security number if I remember correctly.
So then they'll know it's been used
I mean,
on this
listen,
social before.
Who knows if that goes into a black hole at the IRS? Like, I don't know. I've never had anybody be audited on it. I'm not saying it's unauditable because anything can be audited on a tax return, but
Yeah.
And then, second question, for the lifetime learning credit, does that have to be used for someone that's degree seeking, or can it be like on the job?
no, it can be certificates because I did it for my, I did it when I was going for my CFA. No, which one? Certified Financial Planner, CFP, there it is.
So it's just a certificate?
Yeah, it's just certificate programs work.
Any kind of education you pay for
Yeah.
would kind of apply. Any other questions?
I guess I have a twist to that question. If I get a job to pay for it, it's like a tuition benefit.
You have to pay for it out of pocket.
Yeah, out of pocket.
For it to.
Okay. But what if it's in my taxable income?
It's still a benefit you're receiving through the employee because it's a reduced tuition rate, and I'm sure a ton of other stuff. Yeah.
One last question about this. So if, let's say I had a kid and, he majored, he got a undergrad in economics.
Mazel tov.
So
It's a great.
he would have to get a master's in economics, otherwise it doesn't apply? Or does
For
it-
lifetime learning credit?
Right, for the lifetime learning credit.
No. So he can continue on post-secondary education. I was talking most about or improving job skills when I was saying that. Post-secondary education can count towards graduate school.
Okay.
That's cool.
Okay.
But if you're using it as like a certificate program for me, I was okay because I was just trying to improve my job skills. But if I go back, it just doesn't. If it doesn't fall under one, it may fall under the other.
Okay.
It's not a requirement that you're getting a master's in order for that to qualify.
Yeah.
It could be a certificate,
Yeah.
there's your job.
Right.
It could be in a different subject than your like baccalaureate. And then,
I think you're asking very pointed questions with this. Google the form and make sure you just fall underneath it.
And is there a certain line we put our tuition on? Sorry for all the
That's
questions.
okay.
No, these are great.
Nothing, yeah.
It's what's going to happen is that there's going to be on the back of page 2. There's a tuitions and fees. So this, I think it's on like 3,800. It's one of the forms off of form 3,800. If I
Yeah, I forget the
Like,
number.
here's,
Just give the number.
here's American Opportunity Credit.
8863.
8863, yes.
Yeah. So remember how I said all the partying is done in the back?
Yeah.
Right. This is one of those back pages. You're going to report all of this credit for education on form 8863. Then 8863 is going to go ahead and report on line 68. So yes, to your question, it does get reported on page 1 and 2 on line 68, but all of the calculations and all the fun stuff, all the partying happens on form 863.
So it wouldn't be like straight off of the
No.
form 1098? No. Okay.
Only the W-2 is pretty much the only number on the entire tax return that comes straight
Off the form.
off the form and onto your return.
Like on page 1.
Onto page 1. I think that's the only form.
And I think up there, line 50, education credits. I think that's the lifetime learning. That's the same form, 8863. So if you fill out that form, it'll tell you where to then put the number on this page. And you can see if you qualify if you fill out that form.
Yeah, each form that the IRS has will come with form instructions.
Yeah.
So even if you take a look at the 8863 instructions, it'll give you some guidance as to the eligibility.
And if you have multiple jobs, should you add them together and put them on that one line? Or does the W?
It'll do it. Like whatever software you use to prepare your returns. I don't. What does PwC use? You guys use Turbo or something?
So I'm not part of PwC, but
Ah.
I think they use TurboTax. We
Yeah.
kind of
Yeah.
encourage students to use that so they don't
Oh,
accidentally
please.
mess up on their form.
Use it. I'm sure your university provides a benefit or a reduced amount through your bookstore to buy TurboTax. Please use TurboTax.
Yeah, the paper
It's so
forms-
much easier.
Okay.
And it will automatically, it's going to ask you a bunch of questions. It's called interview mode. I use it myself even for a W-2. Like I don't have a lot of stuff going on. It'll be an interview mode. It's going to ask you questions like, hey, did you get married this year? Hey, do you have kids? Did you have an employment with somebody? And if you answer yes, it will have you drop in the information. And if you put in the right information in some of these things, it'll automatically pull all the income in for you. Like if you use TurboTax year over year, you can set it up so it connects to your bank, so it connects to your employer, and it'll just dump the information in, and you'll, like I think I filed a tax return faster than it took my wife to get ready one night. Like I sat down, I was like, hey, I'm gonna do my taxes, you get ready. I was done before she got ready. It was like less than 20, 30 minutes. It's very fast.
Right.
All right, so things are changing. All right, so you guys are starting your tax journeys at a time when all the tax laws are changing. And so all of the things that we talked about, right, not all, but a lot of the things we talked about don't get too attached to, because truly starting this year, 2018, we have a whole lot of changes, not just with individuals, but with corporations, partnerships, right, which is not the focus of this here, but just know that the tax law that passed in December is very wide-reaching, right? And so a few that we wanted to highlight here, so we talked about the standard deduction and how it's going up by a whole lot, right? Exemptions that we spent some time on, gone.
So
So
those
long.
dependency rules on the back here, that's this.
Yeah,
That's gone next year.
Gone, right? Child tax credit, that's going up in case you guys have kids in the future. That's good, right? Insurance mandate is being removed, right? So this probably doesn't apply too much for you guys as students and on your parents' insurance, but this was a really big deal several years back when Obamacare passed, right? Because one of the principles of Obamacare is that everybody has to have insurance, right? So you can, if you don't get it through your employer, you can buy it on healthcare.gov, right? And if you don't have health insurance, the way that they made sure that everybody had health insurance is to assess a tax through the 1040. And so that's going away. Tuition and fees deduction eliminated. This is different from the credits, right? So the credits right below, no change. So that's wonderful for students, right? Even 2017, this one thing went away. Before, if you look at old tax forms, you'll see that on page 1, right, as in above the line deduction, you know that terminology, there used to be, right?
Mhm.
Okay.
Yeah.
There used to be this opportunity to deduct tuition and fees under certain circumstances, right? That's gone. So we're not paying attention to that. Student loan interest deduction, still around, right? If you followed the news, right, in November and December, that was one that was teetering, that may have been cut out, that would have been really bad, right? I would say still in, right? So that's good. The last one, right, is that we today, in 2017, have 7 tax brackets, right? 2018 and forward, I think we still have 7. Right, but the actual range of each bracket is slightly different, right? And the rates themselves are a little bit lower.
33% is the highest, right?
Well, 37.
Yeah, if you include the
No, I think it's
3.8%.
37. Actually, it's a high from
Is
39.6.
it? Yeah, you're right. It went down 3.
Yeah.
Sorry.
So like these percentages all kind of mostly went down a couple percent. I think this is 12 now. And also the income thresholds went down, I believe, right? So you'll just have, you can Google it.
The
and see what
the same approach in how you compute your tax, just the brackets are different and the tax rates are different.
Yeah. AMT is the same, net investment income tax is the same. Oh, so Trump budget. These are just proposed. Keep in mind, this is just a wish list. Every year, every administration produces a wish list. And this is part of their wish list. So eliminates the public service loan forgiveness. This happens, so let's say you're a district, you went to law school, right? And you are now a district attorney and making peanuts compared to your colleagues who went into private practice. Part of this is because you work for the federal or state government, they would allow student loan forgiveness after a specific amount of time. It's usually 10, 20 years. As long as you made your regular payments on time and didn't try to refinance and get cute. By part of the public service, they said, hey, we'll forgive these loans. Trump wants to get rid of this. So, and the second one is under the Consolidated Student Loan Repayment Programs. Currently, there's 4 different plans offered. They want to simplify this and just kind of reduce it. Listen, I don't know necessarily if either one of these will pass. They're both pretty rough, especially people who use IDR, because especially if you, like I was on IDR coming out of college and out of law school, because you make very little to start off with and you hope to grow in your career, and the IDR allows you to tag your payments based on your income at the time, and it's great. Who know, again, none of this could pass, both of them could pass. He could, declare himself lizard monster tomorrow. Like, who knows? Who knows if this will work?
Right. So we just wanted to put this on here so that, if you guys are interested in some of the tax law changes associated with being students, then just, you can follow when the news passes. And that was it. I know we've gone a little bit over, but yeah, any questions?
Those brackets that you were showing, basically the percentages and the amount paid, are those in the back of the 1040?
No, so those you'll use those schedules separately. I mean, if you're just doing it paper, like if you're doing TurboTax, it'll do it for you.
Yeah.
But if you're just doing it on paper, so when you get to the line 44 that says tax, it says see instructions. Basically, you'll pull those forms separately, calculate the tax, put the number on line 44.
Okay, so we have to go online and look for those forms separately.
But I don't think you even attach those forms or anything. You just put the end number that you calculated.
And don't do that. Buy TurboTax. Yeah. I can't stress it.
But if you want to be
I don't care.
diligent, right? So
Yeah.
like if you want to learn how the form works, you can try to fill it
Oh,
out
yeah,
by
yeah.
hand and then compare against TurboTax.
Yeah, I think just to increase overall awareness.
Yeah.
Oh, yeah.
You see how it works.
That's
see how it's
it.
actually
I did that
calculated.
when I was first learning. As a student, I was.
Also, we put our videos up on our YouTube channel, so if there's something in here you want to go back to, we'll have it up within a month. We also have they come every year, so we have past years as well on our YouTube channel. And again, next year will be wildly different, so it'll be like a historical record. So yeah, don't stress if you're like, oh, what did that one person say? You'll be able to go back and look.
Where is this posted?
YouTube. It's our YouTube channel, so go to YouTube GU, letters Common Sense, spelled normally. You can look us up through there.
Yeah, and like she said, and like Jen said before, if you Google if you Google 2017 tax rates or 2017 tax brackets or Google anything dealing with tax, you'll get not only things probably from the IRS, you'll get things from accounting firms and other people like tax advocacy groups. Like you'll get a ton of information. So whatever you want to know about taxes out there. And like you said, all the forms have instructions, very detailed, specific instruction, line by line, box by box. So if you ever have a question, if you are being that diligent person who likes to learn tax, and you want to calculate that, follow the form instructions to a T, and you can't go wrong.
Can we take a look at the 1040 breakdown slide? I was all the way up there. Can you see it?
Let's see.
Yeah,
This one?
Yeah, I got a picture of this.
Okay, other than that, are there any more questions? So on Monday, we have our Housing 101 workshop. You can look on our Twitter and Facebook to see exactly what it is. It's also GU Common Sense. And if you have any questions about other workshops, things you'd like us to host, you can email us at gucs@georgetown.edu. Round of applause for our wonderful presenters. And if you could grab pizza, whatever's left, otherwise it's just gonna go to my office refrigerator.